To start off a new year is a wonderful time to reflect on our financial choices. It's time to look back at our spending habits and investments from the previous year to see if they were in line with our overall financial goals. The goal here is not to criticize or lament the past, but to better understand our own financial behavior. It can assist us in aligning our actions with our life objectives or in rethinking some of our financial judgments. Reviewing your finances on a regular basis is also an important element of financial planning. Money management isn't simple, and it necessitates a candid examination of your financial habits, biases, expectations, and cash flow. But it's necessary if we want to develop financial discipline and have a better understanding of our own behavior. In the end, it's the first step in bettering your financial situation. Steps to a better financial future. The term financial health relates to your financial situation, a continuous flow of income, a growing cash balance, a strong portfolio, and regular expenses that do not exhibit any abrupt jumps are all signs of good financial health. Getting to this point can be difficult, especially if you're starting off with a low salary and a lot of expenses. This is when budgeting comes into play. A smart financial plan should keep you on track to meet your long-term financial objectives. Number 1. Examine your holdings. It's vital that you evaluate your portfolio on a regular basis to maintain track of the state of your assets, how they are aging, and your cash flow. Your investment portfolio will alter as you get older to match your risk profile. For example, when you are young and have few dependents, you are more open to high-risk, high-return ventures. In your 40s, on the other hand, you're more inclined to be cautious because you may have several liabilities and can't afford to take big chances. The end-of-year portfolio review is also a good time to gather all of your investments in one place and look at their overall asset allocation. All asset classes are included, including gold, real estate, mutual funds, ETFs, and stock. The next step is to track your investment returns throughout the course of the year to see if they reach your expectations. So, where does your investment stand now if you expect a 12% return on a mid-cap stock? At the same time, you can compare an asset's weightage to its returns to determine the right balance of high returns and stable investments. The portfolio review provides you with an accurate image of each asset's weighting, as well as the total return on your portfolio, and allows you to revisit this distribution according to your current risk tolerance. Number 2. Look out for any unnecessary expenditures. Understanding our spending patterns is one of the main goals of a review. While we may intend to stick to predetermined spending limits, the majority of us are generally oblivious to our real purchasing patterns. This is why our savings at the end of the month are frequently lower than anticipated. Fortunately, we now have the tools to more accurately track our actual spending. The first is to try to keep a monthly budget spreadsheet in which you note each purchase or outflow from your account. Check your bank account, including any credit card purchases. If maintaining a spreadsheet seems too difficult, unnecessary expenses or unhealthy spending habits, such as an annual magazine subscription that you no longer read, are likely to be discovered. Buying high-end electric items or overpaying at restaurants are those examples of bad spending habits. The first step in coping with these tendencies is to recognize them. Reduce your eating out and examine your subscriptions carefully. On the other hand, it can assist you in budgeting for unexpected expenses, such as housing customers for lunch or purchasing gifts for friends or coworkers. You can set aside a certain amount of money each month for such costs. Number 3. Set up an automated savings or investment plan. Automated savings and investment is one of the safest strategies to maintain adequate cash flow. It's especially effective for people who find themselves spending more than they should. The yearly review can help you figure out how much you should be investing in your portfolio monthly, quarterly, half-yearly, or annually. Automating your finances becomes even more critical for long-term investments that may not appear to be significant now. This includes putting money into a retirement fund when you're in your 30s, or purchasing health insurance when you're young and healthy. We can ensure that our prejudices do not prevent us from making these investments by automating these savings. To ensure that these allocations are made as soon as you have adequate funds in your account, you can set up automated transfers in sync with your revenue cycle. It also ensures that you never miss a payment or premium payment. It also helps you retain financial discipline by ensuring that you have a clear limit on your spending potential. Number 4. Distribute your funds among several investing options. What is the extent of your financial portfolio's diversity? Thanks to the portfolio analysis, you should have a very decent notion by now. As you consider your whole financial situation, this is an excellent time to expand it further. However, when redistributing your portfolio, you must keep your current financial conditions and your individual risk profile in mind. While pharmaceutical businesses led the way last year, sectors such as fintech, real estate, manufacturing, logistics, and automotive are likely to grow in 2022. This year is projected to see a flurry of initial public offerings, IPOs, with enticing investment opportunities in high-growth firms. The rise of startups and investment in the digital economy can help you diversify your portfolio by adding more small-cap, high-growth companies to your portfolio. With some of these stocks on the rise, now is a great time to diversify your equity portfolio. Investing in large corporations, government securities, and mutual funds, on the other hand, will ensure a more steady balancing act. Similarly, you can restrict your exposure to a single economy by extending to multiple markets, such as the United States. It may also assist you in avoiding the effects of the rupee's depreciation. 2022 also presents an opportunity to work towards long-term assets such as real estate or to increase your retirement corpus by investing in retirement funds. Number 5. Increase the size of your emergency savings. The last 2 years have demonstrated the value of having a savings account and a nest egg to assist you to get through difficult times. An emergency fund is intended to provide us with financial safety net in the event of an unforeseen financial setback, such as a loss of income. It can also include unanticipated large bills, such as expensive car repairs. Loss of income or unexpected expenses can have a negative influence on our general lifestyle, but they can also jeopardize our portfolio if we fail to make regular payments or are compelled to liquidate part of our assets to satisfy our obligations. The purpose of an emergency fund is to cover all of these costs in the short term. Depending on your income and costs, it might be anything from 3 to 6 months of your wage. Many of us face increasing responsibilities as we become older, such as school or college fees for our children, EMIs, loan repayments, or property rent. People with a lot of liability should put up a reserve that can last at least 6 months if they lose their job. It's better to keep the amount in a separate savings account to avoid overspending it, especially if it's a modest one. For a large fund, it's ideal to invest in a highly liquid fund like debt mutual funds, which will allow you to grow your money while also allowing you to swiftly cash out your assets if needed. Number 6. Examine your debt and restructure your budget. Debt may appear to be a burden, yet it is often an unavoidable element of modern life. And in some situations, it may even be preferable to paying in cash for every purchase. However, knowing your debts at the start of the year is always preferable. Organize your debt according to the interest rates. Paying off high-interest loans first is always a good idea. Low or no interest loans, on the other hand, can be paid on time and may help you manage your finances more effectively. Working on your budget necessitates a review of your debts and payments. When you look back on the previous year's finances, you'll notice a consistent pattern of spending, investments, and income. These will assist you in creating a more realistic budget that you will be able to keep to. As you revise your investing decisions throughout the year, you can keep changing it. Conclusion. Finally, make the year 2022 the one in which you endeavor to improve your financial literacy. Our happiness is directly influenced by our financial health. It can assist us in meeting our basic and non-essential requirements, maximizing our potential, and allowing us to live our lives on our own terms. It allows us to take time off when we need it, provide for our loved ones, and assure appropriate medical support as we get older. The first step in learning about money and how it works is to become financially literate. You can now get expert help in managing your finances through a variety of venues, including digital and professional services. So spend some time getting to know yourself, your goals, and how to align the two. If you enjoyed our video, please click the like and subscribe button below for more financial tips.